Yeah. So just let me start by making a quick observation that this has been so far quite entertaining and also a controversial session. So I think I'm afraid I have to cut back on entertainment, but not on controversiality. And I guess Jonathan never really told us why we're here. I guess I leave this open to be answered later, but I can definitely promise that there will be some controversial points also going on here in this paper, and maybe if you catch one or two jokes I brought, if I don't forget to mention them, then it might be at least a little entertaining too. So this is joint work with Tim Johnson from the University of Illinois as well, and one of those papers, I think Jonathan also briefly touched on that, where corporate finance meets asset pricing, hence the co-authorship, me being more corporate finance, at least historically, and Tim certainly historically being more asset pricing. We're sort of merging those two areas. So what do we do here? Within a very specified, well-specified class of models, namely real options models, we're wondering what differences in the cross-section of stock returns can be explained merely by those neoclassical standard investment-based models. And of course, this is not a new literature, it's a recent literature. It's a growing one, and a lot of the interesting insights here go back to work by Carlson, Fisher, and Giammarino, and our discussant, Lu Zhang, over here has contributed greatly to that area. So they have always argued that one of the key insights is, at least for a single firm through time, in the time series at least, productivity shocks will affect the relative values of assets in place and growth options, and that will have major implications for the riskiness of the firm, and then the risk-return trade-off, or what we tend to call the risk premium, the expected return profile, will change with time series changes of those shocks. We're taking a little bit of a different take. We want to emphasize that while all of these empirical tests are inherently cross-sectional, very, very little work has been done on allowing explicitly for cross-firm parameter heterogeneity. So we're emphasizing cross-firm differences more than time series predictions that are already better understood so far. And more specifically, our question here is, what do real options models imply if firms differ in terms of their flexibility along two dimensions, expansion and contraction options? So you might be tempted, economic intuition might suggest very quickly, if you have contraction options, or more generally, more flexible firms might be safer, unconditionally safer, and we've seen this without citing any sources here. We've seen this qualitative argument being made, and what we are saying, well, hold on, you need a model really to show. Without a theory or a model, and we're not really making up a new model, we're using a standard neoclassical model, you then see when this intuition follows from a model. And in contrast, there's a very important intuition also already brought about and used many times in some of my other work and other people's work, that expansion options are intuitively a levered position of the assets in place. So if you think about the replicating portfolio of expansion options, right, you borrow and you invest more in the underlying assets. Expansion options are riskier. So if you think of growth options as also adding flexibility to a firm, then things become less obvious. A little bit of background from the corporate side. The empirical investment literature in corporate has documented non-trivial disinvestment rates. They range, of course, depending on what firms you look at. This Hover-Kimian-Titman study looks at 1980 to 2000 CompuStat panel of all kinds of firms. Their disinvestment rates have, I think, an 8% standard deviation, 2% mean, so there's a lot of disinvestment going on. More importantly, the heterogeneity that we're looking at, the cross-firm heterogeneity, has also been studied in many papers here in terms of differences of purchase and resale prices of physical capital. And in fact, if I can pronounce it, Balasubramanian and Sivandasan paper provides us with a third measure of industry inflexibility. They use the census data on purchases of used and new assets in an industry. And so industry inflexibility or illiquidity is measured then by the ratio of new assets over total assets, where the total assets are also the used assets being purchased. And I'll come back to that when we talk about our measures. But there's just a selective citation, and of course the real options literature, for those of you who are familiar with this, has long recognized that investment dynamics are majorly influenced by the presence of investment and disinvestment costs, or already just the presence of disinvestment itself. So prior research in asset pricing, as I said already in the first slide, predominantly looks at time series variation of productivity shocks of ex-ante identical firms, so we want to relax this assumption of ex-ante identical. To explain, somewhat surprisingly, to explain cross-sectional phenomena. So I think Tim and I, we really deserve that. Well, we can put on our slides whatever we want, but we are one of the first papers to emphasize that we need to, if you want to explain cross-sectional regression results, you need to also look at cross-firm heterogeneity. So little work has been done here. The parameter heterogeneity we're focusing on today is just along one dimension of the paper, of the possible dimensions. There are others we have in mind, and in fact this whole, at least for us, this whole project has turned more into a research agenda than in just a single paper. So if I have time at the end, trying to time myself as well, I will talk a bit about what was actually accepted to the program of the conference, but then morphed into sort of a separate paper because there were more and more results coming along from momentum. So we are really now looking at flexibility here and stock returns and value effects, or anti-value effects, as it turns out, can be arising in such a model as well. That's, I think, all for this slide. So what is a summary of results? And I have at the bottom of this slide, it's a busier one. I have at least one sentence, like the discussant told me to be a bit more precise. One sentence that summarizes it all. So there's generally an S shape of the expected return profile. That means some part of the profile might be upward sloping, say because of operating leverage, and then some other parts might be downward sloping. Well, as this common intuition suggested maybe already, firms that are very flexible, that have especially downside flexibility, can become safer when profitability decreases or book-to-market increases, simply because these disinvestment or contraction options get more into the money. On the other hand, when profitability rises, growth options get more in the money, and so the replicating portfolio gets more expensive. You have to borrow more and load up more on buying the underlying assets. More risk is provided in good times by soon-to-be exercised expansion options. So very generally, if you think of it, there is, I'll show some pictures. There's a non-monotonic profile here in terms of the book-to-market return relation. So the type, and that depends crucially on the type of flexibility, upside flexibility, expansion, or downside flexibility, contraction, so that we conclude somewhat controversially, and there's more controversial stuff coming, that the level of returns, there's basically no unconditional relationship between flexibility and return. So the level is kind of a big scatter plot if you look at a simulation later on. However, we can say something about the slope. So, and I'll repeat this later, so the more flexibility you have, the more downward sloping the profile will be, and the less flexibility you have, the more the traditional operating leverage channel will dominate, and the more upward sloping return segments, return risk profile segments you see. So then we also go on and have an empirical testing section and show evidence that there's significant cross-firm heterogeneity precisely surrounding the point that we want to make. Disinvestment contraction options, what happens to returns in bad times in low profitability states. And since this requires constructing measures of quasi-fixed costs or operating leverage and inflexibility, we will, when we see these tests, we'll be led to conclude the second or third time, depending on how many papers you remember in this literature, that the value effect in Farmer-Macbeth regressions does not seem to be explained by those measures that seem to suggest, intuitively at least, or in models, they're behind the value effect, but not in the data. So pushing the literature forward, in our view, is that we should look quite a bit more at asset risk differences that in our model world, and also potentially in the data, differences in characteristics can potentially be like sigma differences. I'll show you in the next slide what sigma is, can be behind the value effect. So a very standard off-the-shelf continuous time partial equilibrium economy here with a stochastic discount factor, productivity shocks, and here's your sigma with a drift mu and a sigma, a diffusion term sigma, correlation with the pricing kernel. It's exogenous, of course, and the standard, market price of risk then obtains here for theta risk. We have a flat term structure, fixed interest, constant riskless interest rate, no agency, contracting, and debt-related problems in this paper. So that maybe also will, at the end, maybe in the discussion, provide for some thought about what extensions could be done. And here's a key element of the production function that we model, which then will be vary across firms. Capital pi is your profit flow. here, which is affected by theta, and then by the capital installed with the decreasing returns to scale parameter gamma minus quasi-fixed cost. M is your fixed cost parameter, and K is the installed capital stock. So intuitively, the more capital you have installed, the larger will be your quasi-fixed cost. And in bad times, this will lead to decreasing profitability, and you would want to undo some of the previously installed capital, whereas in good times, you would want to load up more. If the theta rises, would load up more. There's depreciation as well, it doesn't really matter too much, and then we have quasi-fixed costs that I mentioned here, MK, and adjustment costs will be the first order variation. Based on this slide, the firm will live in a theta K space, so it's a two-dimensional problem that's harder to solve, but we'll simplify, jumping back to the bottom right away since I said that, can go to one dimension by using the ratio of capital over profitability. Unfortunately, then everything will be flip-flopped around, so the high values will be bad times, the low values of Z will be good times, but keep this in mind when you look at some pictures. Limited liability is enforced, and here are now the key adjustment things that adjustment costs that I mentioned at the bottom on the previous slide. You can actually forget a bit about the fixed cost. They can be set equal to 0, and none of the results will change. They're just added for generality, and since the empirical investment literature has given some evidence for those, so I'm going to just skip this point here. The key friction comes from increasing capital, costing PL times the delta, the positive increase in K, where PL is the purchase price. And conversely, there's a negative cost here. So if you have a decrease in K, you have actually an inflow of PU times delta K at a resale price of PU. So all we're doing in this paper is looking at what the risk premium variation will look like when those PU and PLs are changing. As simple as that. And you could ignore for now the fixed costs. I know they may be a bit annoying, and we haven't deleted them so far, but they are very low anyway when we look at parameters, but I won't have time to go through the calibration parameterization in this talk. Well, as many real options models, this one also shares this result that there are discrete adjustment to an SS policy will be optimal. So there's an inaction region, a waiting region, and then there are optimal adjustment points following from smooth pasting conditions, essentially at the and high book to market region here. In the bad times, I said everything is kind of reversed around. High Z is low profitability, low Z is high profitability. I crossed the line. High profitability here, and so we're investing here and jumping back to an interior point, and we're disinvesting here and jumping back to an interior point. All of those are chosen by smooth pasting conditions, and they need not coincide because those adjustment frictions are not symmetric in this case. So fairly general setup. Some key quantities we can compute book to market easily once we have this transformation I mentioned here into Z space. The value function J is generally K theta, two-dimensional, but we reduce it to a one-dimensional that has a nice closed form solution here for V. Z, if you flip to the appendix of the paper, book to market is increasing in Z, the inverse of theta simply, then quasi-fixed cost, our measure of operating leverage. Also monotonic in Z. Clearly, costs have to increase if your capital stock increase and decrease if theta increase if theta decreases. So we have then the key quantity that of analysis, our expected excess return, simply the elasticity of your J value function with respect to theta, and multiplied by the market price of risk here, or pre-multiplied. So this here is then the elasticity in Z space. It's not easy to analyze analytically, since this is kind of a two-sided real option problem. It's not a one-sided where we have clear closed form solutions and can prove everything explicitly. We might do this at some point actually, but in the general two-sided case, as long as we allow for the second option to be there, we can only sign the level and the derivative of those three terms. The assets in place attribute positively to the risk premium. The expansion option also contributes positively to the risk premium, and then the contraction option negatively. So overall, there's a sideways S shape that we see, and I have a little example here to decompose, graph to decompose those effects. So in very good times, the disinvestment option or put option is far out of the money, no effect on the risk premium. However, the expansion option is getting close to exercise. We're getting close to our L point here, and there's a lot of increase in risk coming from the growth option. Hence, when you sum up everything, the increase in risk here, then in the midsection, that's typically upward sloping, or at least less negatively less downward sloping, the assets in place effect, denoted by the green line here, will kick in a little bit, but it need not be upward sloping. I'll show this to you on the next slide. And so when the expansion option is far out of the money, it will not contribute to the risk, but the replicating portfolio of this put option being short the theta risk then is a hedge or is a risk contributes strongly to the risk reduction effect when the expansion option is not present here. So all is coming from this idea. Expansion options are a levered position of the underlying, or the replicating portfolio of the put option is short the underlying and therefore is risk reducing. And that leads generally to the sideways S shape that we've confirmed in 512 cases in simulations. I'll show you one picture of simulations as well. Different values of parameter values clearly imply different shapes, and this is a relatively flat one, I have to admit, but I'll crank up the slope very quickly now, positive or negative. And we've also verified with even more than those that are mentioned here that none of the parameters essentially changes the overall nice curvature we see here, decreasing, increasing, and then decreasing. So here's now the first key slide, and I'll spend a bit more time on the next two slides than on the other ones individually, because there's a lot of stuff going on. We vary from the blue to the red to the black line, the resale price. So this is a low, blue is always low, red is medium, and black is high resale price. So we see quickly the flat, this is just the sum of what we were looking at here in terms of the components. If the resale price is fairly low, then we almost get back to this irreversible, inflexible firm. The asset in place effect dominates for a large range, and there's a little bit of an option effect here from this investment, a little bit of here. But when we switch gears a lot, when we go to a large resale price, then, as I said also already, the effect of flexibility is that it makes the overall risk profile more downward sloping. It can be overall everywhere downward sloping, and just so less negatively so where the assets in place effect maybe influences a little bit more things in the midsection. So what does this mean? Higher flexibility on this slide means lower returns unconditionally. And secondly, we see that the slope of this risk profile is strongly affected by flexibility, or say inflexibility. The more inflexible the firm is, the more upward sloping is your profile. And a third, more minor observation is that, of course, everyone also knows the more valuable an option is given some profitability level, the earlier you will exercise. So you see for the more flexible firm here, the operating range it chooses between U and L is much more narrow, so in expectation it exercises more often than the inflexible firm. So this operating range is also increasing with inflexibility. However, when we now vary the purchase price of capital from low, medium, and high, so then a low purchase price means more flexibility, and just the opposite obtains. So the more flexible firm has a positive relation. Remember, here was a negative before, there's a positive now. And so showing directly there's no unconditional relationship between flexibility and returns. However, we're lucky enough to see here the same as in the previous slide. The more option effects we have, the lower the purchase price is, the less pronounced is the upward sloping segment. So we can conclude that inflexibility is, although the options affect risk in the different directions, opposite directions, at least the general result is that more inflexibility means a more upward sloping risk profile. That's kind of concluding the comparison here, I think. We can, so to account for these different operating regions, and maybe firms might also, depending on differences in parameters, occupy, right? There's no reason that there's a uniform distribution across this range. So we simulate the model and take into account mu and delta and sigma, other differences, and differences in occupation, the size of operating ranges and occupation of those ranges for 512 different configurations. And see if we have slope here, what I just called the upward sloping segment, the average slope, conditioning on the distribution or unconditioning where the firms are spending most of their time, then we more or less see a positive association. The different colors here arise from different specifications of the market price of risk. If we were to redo this, I spared you the details of this big scatter plot. If we were to put the average return here, it would just be one big cloud of, I don't know, fog or snowfall, but no association for the level of returns, only for the slopes. So expansion and contraction options have opposite effects, and yet the common feature for the risk profile is they make the downward sloping segment more pronounced. maybe seems a bit contrary to people's intuition, and I already gave in the beginning some discussion on this. The slope matters. The slope is increasing with inflexibility. And now whether or not, didn't refer back to the anti-value firm, whether or not a firm has a really, really valuable disinvestment option and therefore has, in the value premium kind of lingo, has this anti-value effect here instead of a value effect for the blue type, depends really on what we see in the data. So we take now the key prediction of the model to the data and say there should be a positive interaction conditional result. If a firm is highly inflexible and has high operating costs, then there should be effects on returns. In addition, the literature has evolved today to think that this channel is one of the primary explanations for the book-to-market effect. So if then we put our measure, interaction between operating costs and inflexibility, into a Farmer-Macbeth regression, then one would also hope that the book-to-market effect or the coefficient estimate in terms of economic or statistical size would be somewhat reduced. Our measure for quasi-fixed costs is a rolling 5-year window regression of cost on lag sales and lag costs, and then we get an intercept and a predicted value and scale those for cross-firm comparability, scale those predicted values by sales. Here are 4 inflexibility measures. The first 2 come directly from what we refer to as our measure of the inflexibility here of the real options model, the log of U over L. In the pictures, you didn't need to worry about sigma because sigma was the same in all pictures, but we have also some in the simulations heterogeneity for sigma. So the scaled log range is what we also measure in the data here. Operating costs over sales, the ratio, how much it moves. Either we take for each of the 48 pharma French industries the median across firms, or we already, in a second attempt, we take an aggregate, we add up all firms in an industry and then again look at the range. The third measure is capital illiquidity directly coming from this RE Stud paper, using census data on purchases and sales of used and new capital in the manufacturing industries, 2,000 to 3,999. Then we run a big panel regression per industry of cost persistence. So this is the kind of the corporate finance way to estimate maybe cost persistence. All those 4 measures will give similar results. Let's first look at some industries. So what are the most flexible or the lowest inflexibility industries? There's liquid stuff. Beer apparently and liquor seems to be very flexible. Coal is an outlier. Intuitively, you would think they're more inflexible and their market cap is very small, but here then the inflexible ones are construction, tobacco, medical equipment, so on. So first result on portfolio sorts, when you think about, well, these are industry now, industry measures of inflexibility, and when we go from, say, high inflexibility to low inflexibility, where we have on the x-axis our operating cost measure, we see now that the average return for a very inflexible firm here, the blue guys, is increasing more than for the black guys, for the triangles. So we have a rotation downwards if firms become more flexible, as the model suggested. And that's cross-industry heterogeneity. These are industry measures, of course. However, for the second, this is inflexibility 1. For the industry aggregate measure, we see even more interesting results. Pay attention again to the kind of the typical value effect, upward sloping, the blue guy on average, but the very flexible guy, the black guy, has downward sloping returns, meaning clearly they seem to be exercising their disinvestment options and lowering returns, at least as far as we can interpret those portfolio sorts. And we put this, of course, as everyone does, in a Farmer-Macbeth regression framework. Thanks. And do first just the variables we defined and find a positive, as the model predicted, a positive interaction effect. But to avoid undue influence of outliers, we just prefer panel B, where we use percentile rank variables and see again a positive significant effect of our variable coming from the model. Inflexibility interacted with operating costs. However, if you focus here on the blue guys, the book-to-market effect, regression coefficient, economically or statistically, has little respect for our measure and just doesn't want to move, and that's a little bit bothering. Well, at least for the people who think that the irreversibility operating cost channel is underlying the book-to-market effect. Other results are as predicted. I should say quickly, there are a couple of, so we think basically based on also two other studies who had similar kind of Farmer-Macbeth regressions, when they added their measure of degree of operating leverage here, the book to market kind of didn't really move much, or here as well when you kind of add, see where with operating leverage is here, and then the book to market comparison is those two. So we're not really the first study to make this point, but the point we want to make here as a conclusion of the empirical results is that the literature has to move on and think about what different channels, and the one we emphasized earlier is that there might be cross-firm differences in risk parameters, say rho, the correlation with the pricing kernel, or sigma, just the diffusion coefficient of the theta risk. So I have about 5 more minutes or 4 more minutes. I time myself, I have 3, well, I have 4, anyway, I'll run over 1 minute. So the paper that was accepted had more results, and some of those are quickly outlined here. Since we have this S shape, this implies something for return autocorrelation. Whenever you are on a downward sloping segment, bad news today will lower returns, downward sloping segment, but then future expected returns will be even lower, so that means return continuation. Downward sloping segments, remember, were driven by the disinvestment options and the investment options, so at the endpoints, and now I transferred everything away from Z but into Tobin's Q space here, so for low Tobin's Q firm, lots of disinvestment options drive return continuation. While it's negative here, there might be reversals here, then it's again more return continuation for the firms that are investing. That can be taken directly to the data in a 2 or 3 step, in a big panel regression of quarterly returns, where we emphasize the logic that if we are low Q today at time t, and we have a low return following at t+1, then future expected returns should also be lower. So we have to keep track of time here. T+1 excess return is our dependent variable. And then we are Tobin's Q conditioning industry relative to industry average Qs to be low to high in terms of quintiles, the return at t+1, but where the Q comes from time t. And it's all somewhere in the earlier version of the paper. But what we find is typically we find this U shape being borne out for raw returns and for excess returns in the data for quintiles and for deciles. This is kind of cool because there was work by Sagi and Seascholz, and I've seen Mark here today for investment options driving momentum, and then there's independent work that was done by Galappi and Jan for shareholder advantage, bargaining power in distress, maybe explaining momentum for distressed firms. And we're putting somewhat the upside and the downside together in a different way, where the upside, of course, is the same as Sagi and Seascholz, and the downside is disinvestment instead of distress or renegotiation in bad times, and find similar patterns. Importantly, we have thrown out, it's not in those pictures, but we have additional pictures where we've thrown out high debt firms, so that most likely this will be not behind our results. Last point is the most exciting stuff is now simulating heterogeneous panels with, say, half and half equal numbers of those firms, and those firms, the black and the blue guys, will enable us to have a cross-section of simulated firms that only differ in terms of their flexibility or their upward sloping versus downward sloping profiles. And remember now, I just explained the momentum guys are the ones that are more downward sloping, whereas the upward sloping guys are the ones that are value guys. So the question we are I think I still have in 30 seconds, I'm in the position to show, is that we have model implied coexistence of reasonable value and momentum effects in a calibrated. I can't defend my calibration here or our calibration, but we can talk about it. So what we see in these Farmer-Macbeth regressions in this is that there's a momentum, positive and significant momentum result. Value is also positive and significant. They coexist, and more importantly, see that the significance here of momentum actually increases when we add value, and most importantly, when we just throw in the standard market factor, while the statistical significance gets a bit reduced. The market factor does not absorb in these simulations the meaning of the significance of book to market and lagged return, 12-month lagged return. Another prediction that's a bit similar to our Q conditioning is just a condition on investment. So in the simulations, we can also do two-way sorts on losers and winners returns over the last 12 months, and then also go on the vertical axis from disinvestment here, soon to be disinvesting or soon to be investing firms. And we see again in the simulated data a U-shaped pattern for more successful momentum returns or profits in the low investment firms and the high investment firms, which is completely confirmed in the data when we go to CRISP and CompuStat, where our investment model is basically using lagged Q, lagged cash flow, lagged investment, and lagged one-year stock return. We're predicting investment like the model, like the real options model suggested, predicting investment in the CRISP CompuStat universe from 1960 to 2010, and find a similar U-shaped pattern here of the winners minus losers momentum profits along the expected investment deciles. So to conclude, it's a first look at parameter heterogeneity in a real options framework. We have a fairly simple model, but with more complex parameter heterogeneity. General risk profile seems to be always sideways S-shaped. That implies a conditional U-shape. Also implies that the average slope of the profile is related to inflexibility, but not the level. And we have in simulations coexistence of value and momentum effects that are economically smaller than in the data that Lou and others are looking at all the time. But we didn't put in leverage and other frictions. So we have a simple real options model that yields a remarkable number of interesting implications, not previously derived or tested. And since I guess I'm the real options guy like Tim as well, lends strong support for the existence of real options effects in the cross-section and time series of stock returns. Thanks.